Welcome to the Explainer. Okay, today we've got a seriously fascinating task ahead of us. We are going to decode the highly complex Q1 2026 earnings report from Nicolet Bankshares. Now, usually, an earnings report is just a basic scorecard, but in this case, a single set of numbers has managed to create two wildly different stories in the market. Depending on your perspective, you're either looking at a bank perfectly positioned for a massive growth trajectory, or you're seeing a bank flashing some pretty serious warning signs regarding credit risk. So our goal today is to examine the exact same data from both angles, keeping things completely objective.
So let's dive into this and look at the agenda for today's explainer. First, we'll cover the Midwest One merger impact. Second, we'll untangle GAAP versus core earnings. Third, we'll explore the bull case on margins, before flipping to number 4, the bear case on credit risk. And finally, number 5, we'll wrap up with valuation and price targets.
All right, kicking things off with part 1, the Midwestern One merger impact.
To really grasp what's going on with Nicolet's first quarter, we have to rewind to February 13th, 2026. $6.1 billion. That's the staggering amount of assets added overnight by the Midwest One merger. Just to put that into perspective, that is roughly the GDP of a small island nation, just absorbed in a single day. Nicolet issued about 6.6 million shares, valued at $1 billion, to make the whole shebang happen. This instantly ballooned Nicolet's total period-end assets to $15.6 billion, completely transforming its scale and making it one of the absolute largest community banks in the upper Midwest. And along with those assets, they brought in $4.4 billion in loans and $5.3 billion in deposits. I mean, we are talking about a completely different bank today than it was in 2025.
Moving right along to part 2, GAAP versus core earnings. Now, with a structural shift of that magnitude, you can probably guess that the headline profitability metrics for the first quarter got, well, incredibly messy. So before we get lost in the math, let's quickly demystify a crucial term here, core net income. Think of this as the underlying, repeating health of a business. As noted in the filings, it's kind of like looking at a household's regular monthly salary, but completely ignoring one-off windfalls or, say, a massive one-time roof repair. Analysts use this core number to look right past those one-off costs, like a giant bank merger, so they can see the steady, reliable earnings the business should actually produce going forward. And this brilliantly illustrates why that specific definition matters so much. On one hand, we have the reported GAAP earnings, which came in at just $15.2 million or 81 cents a share. Now, that number was heavily dragged down by a whopping $40.7 million in one-time merger-related expenses. But on the other hand, when you actually strip out those one-off costs, the underlying core net income is a robust $51.5 million or $2.75 per share. That massive gap between the two numbers, that is the exact battleground where the market narratives totally divide. Which brings us to part 3, the bull case and margins. Let's shift our focus to the optimistic perspective first. Why do the market bulls look at this super messy earnings report and absolutely love what they're seeing? Well, they point straight at some incredibly strong indicators. We already mentioned that $51.5 million in core profitability, right? Well, that translates to a stellar core return on average tangible common equity of 19.30%. But it's not just the past numbers. The bulls love management's confidence going forward. Nicolet actually increased its quarterly dividend by 13% to 36 cents a share, and they're strategically optimizing their footprint with a pending all-cash sale of their Denver branches. Look, a bank simply doesn't raise its dividend by double digits right in the middle of a complex integration if it's secretly worried about its underlying cash flow. And to see how this builds a really compelling profitability argument, check out the steady upward trend in Nicolet's net interest margin. It reached a very healthy 3.98% in Q1 of 2026. What this effectively tells us is that despite all the integration noise and the wildly shifting rate environments we've seen, their core lending spread, the difference between what the bank earns on its loans and what it pays out on deposits, is holding up beautifully. To the bulls, this is a highly efficient, incredibly well-oiled profit engine. Okay, time to play objective referee and pivot to part 4, the bear case and credit risk. We have to completely flip the script now and look at this exact same earnings report through the highly skeptical, cautious eyes of the market bears. To really get their argument, we need to understand non-performing assets. Basically, these are loans where the borrower has fallen behind on their payments. Having a high level of these assets is a strong indicator of potential financial trouble. For bank analysts, this is literally the metric that keeps them awake at night. And what's genuinely startling here is the sheer velocity of the jump. Think about this. At the end of 2025, Nicolet was sitting on a very manageable $32 million in non-performing assets. But by the end of Q1 2026, that number spiked sharply to $79 million. Now, obviously, this is a direct, albeit uncomfortable, consequence of inheriting that massive Midwest One loan portfolio. But to the bears, taking on $4.4 billion in new loans and instantly seeing your non-performing assets more than double, that is a giant flashing red light.
And the bears don't stop there. They build their case further with some pretty glaring flags. The efficiency ratio spiked to a bloated 80.3%, which was heavily driven by that $40.7 million in merger expenses we talked about. They're deeply worried that these rising costs are just absorbing way too much revenue. On top of that, trailing 12-month earnings growth has slowed to just 3.4%. That is a massive drop-off from Nicolet's long-term historical trend of 19.1%. So the bearish argument is essentially that reported profitability is becoming way too sensitive to credit events and rising overhead costs.
Finally, let's bring it all together in Part 5, valuation and price targets. So, we've seen the rock-solid margins championed by the bulls, and we've seen the very real credit risk fears highlighted by the bears. But synthesizing all of this, the crucial point is this: Nicolet is absolutely not priced like a struggling bank. In fact, it trades at a remarkably rich premium compared to its peers and the wider industry. While the average U.S. bank is trading at a price-to-earnings ratio of about 11.7, and Nicolet's direct peers sit around 17.1, Nicolet commands a hefty 22.7 times earnings. The market is clearly paying up for something here.
And this creates a truly fascinating valuation tug-of-war. The stock is currently hovering in the low 140s. Yet, despite that high PE ratio we just talked about, analysts actually have an average price target of $176.20. And it gets wilder. A discounted cash flow fair value estimate puts its intrinsic value way up at $231.46. So why the disconnect? Because analysts are forecasting an incredibly aggressive revenue growth of 22.6% per year. This leaves investors in a really tricky spot, right? You have to weigh the near-term capital costs and headaches of this integration against the promise of long-term explosive growth. Which brings us to our final provocative thought for the day. You've got the bullish evidence, expanding margins, rising dividends. You've got the bearish evidence, jumping non-performing assets, slowing trailing earnings. Ultimately, as an investor digesting this explainer, you have to ask yourself, does a projected, highly aggressive 22.6% annual revenue growth truly justify paying a 22.7 times premium in an environment where credit risks are visibly rising? I really hope this breakdown has equipped you to apply these analytical tools to your own market research. Thank you so much for joining me, and as always, keep questioning the narratives behind the numbers.